Now we shift to Europe, and Europe is the interesting one because that's where we see the most pressure. We'll talk about March and where March is and how April's shaping up. So I think, obviously we're going to talk about the Eurozone aggregate. Economic confidence, right in line, was expected at 108, came in at 108.5. Industrial confidence increased from 8.9 to 10.4. Service confidence to 10, expected at 10, came in at 14.4. But the consumer confidence maintained that negative 18.7. And that's where I see the most problems, the most issues when we look at where things are happening on the consumer front. And we'll talk about that more in a second. Manufacturing, as we were saying last month, is slowed a bit from 57 to 56.5. CPI estimate was expected at 6.7, just blew through estimates at 7.5% month over month. Expected at 1.8, came in at 2.5. Core right in line with 3%. Now, the investor confidence for April was expected at negative 9.4 and came in at negative 18. So when you look at the pivot, and that's what we've been talking about, the issues we continue to see and the concerns that we have is that March finished weaker and now April's continuing, which is why when we look at Europe, we do think that they are already in a recession with negative growth. And remember, in Q4, barely there, Q1 barely there. So again, we think that it wasn't much to take to get to that level. Eurozone service did come in better at 55.6 versus the estimate of 54.8. But Eurozone, the comp complete, so it was expected 54.5, came in at 54.9. But when you look at the inputs, so prices paid, everything exploded higher, which is a net negative when you start looking at what is happening for inflation, what is happening to the consumer. And then delivery times also got worse because they've gotten better in the US, but they continue to get worse in Europe, which again, even though that's a net positive contributor to the PMI number, for economic reasons, that's a net negative. And again, those are some of the differences. Now, when you look at PPI, right in line, came in at 1.1% month over month, year over year, 31.4%. Again, exploding, going to the moon. So then when you start looking at Russia's invasion of Ukraine has pushed costs for Eurozone businesses sharply higher. Now, it takes time for that to filter through, and that's where we continue to see the issues from March into April. And then you look at that investor confidence, you're now deeply negative, and you're back to where we were in 2011. If you remember 2011 and the Eurozone crisis or the European crisis, PIGS, for those that remember, Portugal, Italy, Ireland, Greece, Spain. You're in a similar situation to that, which is why we continue to see some of those pitfalls and problems. Now, when you look at the Eurozone, manufacturing PMI fell to 56.5 to signal the slowest growth in manufacturing conditions since the start of 2021 amid intensifying price pressures and supply disruptions. Again, those are the key issues that we continue to highlight, which is going to lead to more slowdowns. But then when you look at energy and power, energy burden as a share of GDP is sharply higher in Europe than the US by 9.3%, and in the US it's at 4.4%. So it's still meaningful, but not to the same level as Europe, and they don't have the same strength on the consumer because they never recovered really from 2011, and they never have. So when you look at 2011, you never really got back to a lot of strength. You recovered a bit, but never back to the pre-period. And then you're not even anywhere close to 2014 to 2020 levels, which is what we showed not last week, but the week before. So now when you look at your LNG import terminals, you can look at Germany continues to plan to build some. Poland has had another one planned. And there's more expectations to see some of this come through. But it takes time to build these. It takes steel. As we talked about in the end of segment 1 and the beginning of segment 2, what steel are you using? What is the cost to do it? So again, a lot of these things continue to be an overhang as inflation hits new highs in the Eurozone when you consider the ECB target of 2%, and we're currently printing something closer and over 7%, leading to more of those issues when you look at the summary of views on the extent to which current cost pressures will be passed through to the consumer A lot. It's just a lot. And I think it's a funny component because when you look at business, energy, consumer, everything as much as possible will be passed through. Not all of it, which is going to hit margins, but it's also not obviously going to hit the consumer hard. March power surge, the average monthly day ahead prices across Europe. To give you an idea of the cost to individuals in Spain, France, UK, Italy versus last year, this comes out of discretionary income. This impacts income specifically because you have to provide this. You have to make up that difference, which becomes so onerous given the fact that wages have not adjusted to enable this level. Eurozone loans to business have remained flat. That's something that we don't see changing, with household loans again creeping a bit higher, but we do expect some of that to roll over in the near term. Eurozone CPI was expected at 6.7%, came in at 7.5%. Eurozone core was expected at 3.1%, came in at 3%. You just get an idea on just how quickly and how aggressively they're moving to get an idea of the pain that is going to continue to come down the pike. Now, when you look at market Eurozone manufacturing, expected at 57, came in at 56.5. But new orders, again, leading indicators came down again. And that's where we continue to see that slowdown, those pressure points. And that's the leading indicator we're talking about. Those are the problems we're seeing. And the costs that are associated with that are massive when you start thinking about where are exports, because Europe, especially Germany, is an exporting nation. Where's China? China's a big buyer of their stuff. And again, that's going to continue to weigh on some of these prices. Eurozone consumer confidence, major purchasing intentions, firmly negative and getting worse. Again, those are things that we don't expect to adjust. Russia GDP, obviously getting just absolutely annihilated. And then the view is that, the forecast for German GDP is continuing to slow, continuing to come negative, move closer to negative. And that's going to be that bigger overhang just because Germany is such a large part of the Eurozone figures. So then when you start looking at Germany, speaking to how important they are, CPI month over month was expected at 1.6, came in at 2.5. Year over year was expected at 6.2, came in at 7.3. Retail sales were expected at 5.5, came in at 0.3. And remember, February was supposed to be a little bit better, now heading into March, which again, we know is going to be a bit weaker. Manufacturing was expected at 57.6, came in at 56.9. It was a bit surprising. I was expecting that to stay a bit firmer, just given where auto sales are. Not auto sales, which have weakened, but the backlog, keeping things a bit elevated. We have not had that. Exports came in better, expected at 1.5, came in at 6.4. Imports came in better, was expected at 1, came in at 4.5. But we're talking about how things improved in February and then got worse in March when you look at those timing delays and supplier delays. So again, that's where we think things get a bit worse as you come into the March. Services was expected at 55, came in at 56.1. And then when you look at factory orders, again, leading indicators, the orders were expected at negative 0.3, came in at negative 2.2. Global German construction, the PMI, came in at 50.9. All of these things continue to show some of that additional slowdown. Not quite negative yet, outside of obviously factory orders and some of those other pieces. But that's, again, the cracks are there as inflation continues to bite. And because you're dealing with the consumer, which is a fickle entity, trying to hone in on when that consumer kind of breaks is always a bit harder, but that's something that we think is very much around the corner. When you look at German business expectations, we're expected at 92, came in at 85.1. Below where we were in 2011 and coming in closer to where we were in 2009, as Spain PPI just utterly roofs to 40.7 in February and it's going to continue to get worse in March. So then when you look at IFO business climate, you can see that expectations are now negative. When you look at assessment is negative, business climate is negative, manufacturing, IFO. When you look at business climate is now negative, expectations are negative, assessment of business situation worsening but still positive. Then you look at service sector, expectations are negative. Business climate is just kind of bumping along expansion as situation continues to remain flat. Trade expectations firmly negative. Business climate, again, negative as well. So when you look at the leading indicators, things going forward, that's where we continue to see a lot of these pressure points that just aren't alleviating and are only, just struggling and making things a bit more painful. So then when you start looking at German year over year, just to put it into context, when you look at inflation is expected at 6.8, came in at 7.6. Eurozone industrial confidence came in, it was down, better than expectations, but again, moving in that wrong level. With German consumer confidence, income expectations are now firmly negative, which means income isn't going up. Inflation is ratcheting higher, but yet you're not going to be able to cover that, which is why the willingness to buy is getting worse and just showing that break and that slowdown in the consumer with the price pressures have broadened. And that's what we've been talking about, is the amount of things that are increasing is only going higher, which is why the euro area continues to see their prices get worse and worse. So then when you look at France, for consumer confidence was expected at 94, came in at 91. Inflation kind of right in line, expected at 1.5, came at 1.6. Year over year is expected at 4.9, came in at 5.1. PPI right in line at 1.1, year over year 22.4. So again, surging up. Consumer spending was down. Expectation of 1.1 came in at 0.8. Consumer spending year over year expected at negative 0.9, came in at negative 2.3%. So again, all of these things are just showing that inherent slowdown, and a lot of that February isn't even picking up. Russia, Ukraine, the problems there. Then you look at industrial production for February, expected negative 0.3, came in at negative 0.9. In manufacturing production, negative 0.5. So all of these things really start to show the cracks and the reasons why when we start looking at Europe, you're getting a lot of this negative piece. You're not just slowing, you're actually firmly negative and contracting. And those are some of the issues that we continue to highlight. PMI incoming new business was fairly flat at 57.6, while business expectations for PMI in France came in at 62.6. But you can see it is well off the highs and falling rapidly, which again leads to the additional problems we've been talking about. Input prices in France just exploding higher to 78.3. Prices charged, again, surging to new all-time highs at 59.9. All leading to the underlying problems we've been beating to death at this point. French nuclear output compared with 11-year average is just getting absolutely slaughtered, and it's just because they shut things down, and again leading to additional costs of doing business all around the region. So there's so many pressure points. Europe, we think, is in a worse position than the U.S. for obvious reasons, and that's why we think that when you start looking at where is there a recession, where is there slowdown, where is there negative growth, we think Europe is firmly where that is sitting, and then it'll continue to expand out, obviously. So now in the next segment, we're going to talk more about China, what's happening there, and how things have adjusted given the lockdowns, and where do we see things, essentially progressing from this point.